Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, is capitalism changing right in front of us thanks to the Trump administration? And trade talks continue. What are the best and worst case scenarios for Canada? Plus, extreme weather is extremely costly. That's all ahead. First, for the week that was in business, it's time for the briefs. Inflation in the U.S. rose by 2.7% in July, matching levels in June, while the core rate edged higher to 3.1%. Both numbers are outside the U.S. central bank's target of 2%, but markets were relieved to see little sign of price pressures from tariffs. The trade tiff with China continued as Beijing raised tariffs on Canadian canola imports to 75.8% this week after it accused Canada of dumping the seed into the market. The trade dispute began last year after Canada imposed a 100% import duty on Chinese electric vehicles. Wildfires continue to burn across Canada this week as the summer tracks to be the second worst on record for hectares burnt. Manitoba and Saskatchewan count for more than half of the area burned so far, but BC, Alberta, and Ontario are also above their 25-year averages, and the Atlantic provinces continue to battle out-of-control blazes. Canadians continue to shun U.S. travel. StatsCan reported the number of residents who drove to the U.S. in July was down 37% compared to last year, while air travelers fell off by 26%. Meanwhile, Americans headed north in lesser numbers by car to the tune of 7%, but visits by air were basically level with a year ago. Air Canada began canceling flights this week in the face of a possible strike by its flight attendants this weekend that could see more than 10,000 flight attendants walk off the job. Air Canada said 130,000 customers a day could be disrupted in the dispute over wages and unpaid hours. Gildan Activewear is offering $2.2 billion to acquire Hanes brands. Hanes is struggling with higher tariff-related costs and a stock price that has tanked since January, while Gildan's share price is trading close to all-time highs. A bid for Hanes was at the center of a boardroom battle at Gildan that saw the brief ousting of its CEO in 2023. And those are your business briefs. This week, the Trump administration said that while it will allow two key chip makers to sell to China after all, it will only do so if it gets a piece of the action. It's just the latest cash grab that CEOs have submitted to, likely not the last. Stuart Trew is Director of Trade Investment Research at the Canadian Centre for Policy Alternatives. Stuart, thanks for being with us.
Hi, Amanda.
So the concern here, of course, is that what we would understand as the rules of how capitalist systems work are being upended. Where does it leave us when we can't really count on the U.S. to play sort of the stable role that we've seen for hundreds of years?
Yeah, you're right. None of the rules seem to matter anymore. The rules that were, let's be honest, set over the past 40 years by the United States, if we're looking at trade rules in particular, they have a tendency to do this. I mean, in a sense, it's not unusual for the United States to all of a sudden pick up and change everything in order to benefit itself and its companies. We've seen this a number of times, like with Nixon in the 70s, for example. But yeah, it's very hard to operate for Canada to think through what is our relationship to this government south of us? What should we be preoccupied with? I mean, in a sense, we can't really do much about it. This is the new reality. We have to work with it. We can't really get too worried about, fretting about it. We have to kind of worry about our own ship in order, I suppose, would be one way to look at it. So, yeah, hard to know where this is going to go. If the chip deal really is a new precedent, or if it's just another of many ways that Trump just does whatever comes to mind at any given moment, and there's no coherence. It's really hard to know.
And there are many different examples of that. The other one that happened recently that in some ways, Stuart, I guess the thing that I'm perplexed by is why this stuff isn't rattling markets more. And that would be, of course, the firing of the chief statistician at the Bureau of Labor Statistics and essentially saying, this data doesn't matter. It matters enormously, or it has historically, to the bond market, to currency markets. Any change in that data could send ripples around the globe. Now we're being assured from the White House that none of it matters. And yet markets are kind of sanguine about it. What do you make of that?
I think, and this might be a cynical take, I'm not sure, but I do think that overall, a lot of companies and markets and investors see that Trump's on their side, right? He's their guy. He just introduced a budget bill, which has seen one of the greatest shifts of income in the United States from the poor to the rich that we've seen in a long time. Trump seems to be out there to make U.S. companies a lot of money, right? Corporate tax is going down. And so they're willing to give him a pass on some of the things he's doing, right? In the long run, profits are going to shoot through the roof, especially with the tax burden being lowered to the extent it has in this bill. So, they're in there for the ride. They're going to make some money. And I think that's why we haven't seen the markets reacting as much as they did when he first announced those tariffs back in April. We did see a big reaction there, right? If you recall.
Yes.
And so since then, Trump's been, I think, testing the water here and there. What can I get away with this? I mean, that's what it feels like sometimes. This NVIDIA deal as well. It's probably illegal, right? I mean, taxation of companies is a matter for Congress. So whether or not this NVIDIA 15% deal actually survives is an open question. But again, it's just an example to me of Trump testing the waters. Is everyone still on board? The markets didn't budge very much. Okay, let's keep going. And I think we're just going to keep seeing this over and over again.
And as you know, Canada has its own issues, and we have a house to keep in order ourselves. Is there a concern that there's a slow creep of bad behavior, that when, as much as we don't behave that way, we still adhere to the rule of law here, but when we see the rules of international trade or commerce being upended, that there is sort of the fear that we will also start to blur some lines as time goes on?
Yeah, I'm a little worried about that too. I mean, when we think about, they're calling it in the States, this kind of pay-to-play economy, like if you flatter Trump enough or give him a nice gold watch or something, you're going to get your way on policy. I don't think we're anywhere near that yet in Canada. I do think there are elements of that, though, in this infrastructure bill, the Building Canada bill that the federal government has announced in terms of, well, what are the criteria for what kinds of projects are in the national interest? And these were raised at the time when it was being passed earlier this year, and I think they're going to come up again as the projects start to be announced by the government. Again, I don't think we're there yet, though. I think we are kind of sticklers in Canada for the rules. And I think that there are ways to work around Trump, right? Trump is a powerful country. The United States is a powerful country, I should say. There's a lot of desire on the part of Canada's other trading partners to think through this moment as well. Non-traditional trading partners as well. The Global South obviously has a huge interest in some kind of stability outside of the U.S. market, if that's closing off to them. So I think that, that's an area where Canada can have a role internationally, is working around this chaos in the United States, right. But also figuring out how we're going to build our own economy out, right, in ways that are maybe less dependent on access to the U.S. market, less dependent on those exports.
Stuart, so good to have you for this. Appreciate your time.
Thanks very much.
Stuart Trew, Director of Trade and Investment Research at the Canadian Centre for Policy Alternatives. Coming up, extreme weather comes at extreme cost. Stay with us. Welcome back. From wildfires to flash floods, extreme weather is damaging and dangerous and expensive. Here's a look by the numbers. This year's wildfires already make it the second worst season on record. So far, 7.4 million hectares have burned. That's double the 10-year average at this time of year. In the worst year for fires, back in 2023, 230,000 people had to evacuate their homes. 5,500 fires burnt 17.3 million hectares of land. The cost that year was enormous, $945 million in insured losses, but the effect on local economies was also severe. The businesses affected by the Jasper fire accounted for 10% of local GDP. Meanwhile, flooding costs $2 billion in structural damages every year, making it the largest natural disaster in the country annually. It's expected to get worse thanks to rising sea levels and heavier rainfall, and due to the fact that in 2024, 80% of Canadian cities were located in a floodplain. Last year, insured damages across Canada from severe weather added up to more than $8 billion, triple the insured losses of the year before, and 12 times the annual average of the previous decades. Those losses also cost more in insurance. Since 2019, property damage claims rose 115%, while rebuilding costs jumped 485%. Well, as insurance costs rise, more and more people may struggle to afford it, making the future even more precarious when it comes to extreme weather. Craig Stuart is Vice President of Climate Change and Federal Issues at the Insurance Bureau of Canada. Thanks for being with us, Craig.
Good to be here, Amanda.
So we all see this happening. Of course, it's the effect of changing weather, and we've seen the insurance industry responding, but it is only moving in one direction. What's the future look like when people actually find themselves uninsured, as we're seeing already in some parts of Canada and certainly across the U.S.?
Well, it's certainly getting worse and worse. We're seeing more events. We're seeing more catastrophic events in this country, and we're seeing more insured losses. What that means for Canadians is, look, insurers have done reasonably well. They managed to still return value to shareholders despite that incredible, unprecedented $8 billion in losses last year. But they've done that by basically being more selective in what risk they take on. They're reducing their risk concentration in certain areas, playing with the product, reducing coverage limits. And what that means is that the risk is being passed on to, everyday Canadians, you and me, as well as businesses and governments. And that's what we need to think through is what do we do about that residual risk that is increasing and that insurers just aren't going to pick up.
In the past, the insurance industry has played such a central role in helping us mitigate risk. Fires in homes are way down because the insurance industry insisted that we build in ways that were better insulated against fire. Can we do that with extreme weather, or is it just too big a problem?
We can absolutely do that. And it's already happening, but it's not explicit. So, insurers have moved out of high-risk flood areas. The top 10% of homes in this country aren't insurable. They can become insurable if governments invest in risk mitigation, flood defenses, to lower that risk to a point where it meets an insurer's risk appetite. Similarly with fire-smarting communities, if we want high-risk wildfire communities, a wildland-urban interface in BC and Alberta, if we want to keep them insurable, we're going to have to invest more in fire smart, enabling those communities, those municipalities to make the right decisions to lower that risk. So yes, there's a lot that we can do.
And of course, people we count our personal property, the private property. There's a whole lot of public, what we would call kind of self-insured or uninsured risk in the infrastructure we all rely on. Who's responsible for that? The roads, the bridges, the sewers, everything that really the taxpayers really do have to support.
At the end of the day, the taxpayers are bearing most of that cost. Most municipalities in this country self-insure their infrastructure. There is not that much reinsurance take-up in Canada, unlike in some other countries. And as a result, it's really the taxpayer that's on the hook. And that's why it's so important that if we're going to increase building in high-risk areas in order to meet our housing crisis, for instance, that we think carefully about where are we going to be putting those roads, those bridges, that stormwater, those new stormwater management systems. Do we really want to build new communities in undefended areas when really at the end of the day, it's the liability is going to accrue back to those governments?
Of course, one of the issues we have is that this is a global problem. Insurance companies offset their own costs and risk in a global market. Might you see that changing over time, where we actually see the reinsurance market picking and choosing the places it will play because of this kind of shared risk? Some parts of this world are worse than others.
It's already starting. Started with Lloyd's of London back in 2019 that readjusted its exposure worldwide, including in Canada, pulled out of the Canadian commercial market almost entirely. Luckily, they've come back a little bit, but we've already seen reinsurers begin to adjust their exposure. Instead of spreading the peanut butter evenly around the world, they're basically saying, nope, we don't have that appetite in certain parts of the world. And Canada tends to be, unfortunately, particularly Western Canada, one of those areas, as is the U.S., as you can imagine, places like California and Louisiana. So that means that there's less reinsurance in these areas, and that affects the availability of insurance as well.
So the doomsday scenario, and you're going to hate that I raise it, it's a bit like yelling fire in a crowded theater, but are we headed towards a world where it is an uninsured world, which is really kind of the dark ages economically?
Insurers absorb risk throughout the economic system. They play a vital role there. And we are, so far insurance is widely available across Canada, but we are seeing this sort of slow boil situation where they're shedding risk in the places that are, the most, frankly, risk predictable of having these catastrophic events. And so what we're starting to see is like the agreement that Quebec signed with the federal government on June 2nd, which was essentially to say if insurance is either inaccessible, unaffordable, or inadequate, then they're basically saying we're going to pick up the cost for the first $385,000 per property. So free insurance, taxpayer funded free insurance to everybody where insurance isn't available. Feds pick up 80% of that, Quebec picks up 20%. So the industry is watching these deals because essentially it's capitulation. It's saying, you know what, we're building a taxpayer-funded system in expectation that it's going to become more difficult to insure. In our view, we should be doing more to invest in risk mitigation, reducing the risk, keeping places insurable, rather than pursuing taxpayer-funded schemes like this. But we'll see what happens.
So good to have you, Craig. Appreciate your time.
Thank you, Amanda.
Craig Stuart is Vice President of Climate Change and Federal Issues at the Insurance Bureau of Canada. Coming up, trade talks continue between Canada and the U.S. We'll look at what might still be at stake. That's still ahead. But first, Bix Pickles have found themselves at the center of the debate about what makes a product Canadian. The pickle company was founded here in 1951, then purchased by a U.S. firm along the way. The cucumbers are still Canadian, but they're now shipped south for processing and bottling, and that gets them hit with Canadian retaliatory tariffs, even though Bix is a lot more Canadian than a lot of products slipping under the radar. It's evidence that decades of North American supply chain integration has put some companies, well, in a pickle. We're back after this. Canada is still working on a deal with the U.S. administration on tariffs, but how much of any agreement will actually be a complete rewrite of our existing free trade deal? David Patterson is Ontario's representative in Washington. Thanks for being with us, David.
Hi, Amanda.
So this has been on my mind because we, of course, keep talking about the amount of trade that is non-CUSMA compliant. In other words, that has been hit by these now 35% tariffs. It's not very much. Should we be bracing for a future where everything we trade with America has some level of tariff? And should we start figuring out what that will cost us?
I mean, I think as we watch the global change in trade, and as those of us in Washington are keeping a close eye on that, and also working very closely with American businesses, they respond to the new tariff levels that are out there. And we've seen this game of musical chairs, so to speak, around the world, and the countries like Japan and the EU and others agreeing to 50% tariffs on steel and aluminum, 15% on automotive, and those are too high for us. And so those of us in the CUSMA countries, we've always been a little bit different. As you mentioned, we've got the exemptions because of the CUSMA agreement. And so we need to build on that. And hopefully we can get ourselves back to 0%, but there may be a time like we have now where we've got some tariffs, and we're going to need to try and keep pushing back with U.S. business against those tariff costs.
And of course, one place where this will be central to how things develop will be the auto industry. I mean, we've had this free-flowing exchange of goods and services and supply chain between our two countries for decades and decades. As we kind of rethink that, we are already seeing the big manufacturers, David, shifting their thinking about future investments. Are we really ready for this? And I mean, of course, I ask you that because you spent so much time in that sector. You know it intimately. This is a big one for Canada. It may not be where decades and decades from now we should pin all of our hopes, but right now, a lot of our economy and jobs are tied to it.
Well, keep in mind in the auto sector, these types of investments are usually on a 3 to 5 year horizon. We're going through a massive change towards electric vehicles, and that's not going to change. We'll continue to see companies like Ford and General Motors moving in that direction. Just this week, Ford making big announcements in Kentucky in that regard. And we have big companies like Volkswagen reaffirming that they're going to go ahead with their battery plant here in Canada. So these companies are really frustrated with tariffs because they want to get on with being more productive, using artificial intelligence, improving their supply chains, and all these things. But we have to deal with this distraction in the meantime.
And of course, also deal with, as you say, the reality of what's in front of us. Our trade teams are dealing with a White House that is extracting not just large promises, but very unusual kind of promises. We've been talking about sort of the chip transaction where they're taking a piece of revenue from major chip companies and their sales to China. This is a new ballgame, David. So are we really fighting a fair fight in some ways as we try to negotiate on terms that are sort of uncertain?
It's also important to remember that, for instance, in the auto sector, Canada is by far and away the largest market for the United States in the export of automobiles. We buy over 20%. Countries like Japan and Korea, maybe 1 or 2% of what America exports. So we're very important to the United States. And the big game is to compete with China in these areas. And so I think there's reason that the CUSMA countries, Canada and Mexico, are in a different category, and it's going to take longer to get to where we need to go. And it may bleed into the CUSMA type of renegotiation discussions, but we're still hopeful, and we've got a sensational team working in Washington with the ambassador and Dominic LeBlanc to try and get us to a little bit better tariff levels. Thank you so much for your time, David. Appreciate it. Thanks, Amanda. David Patterson is Ontario's representative in Washington. Time for the takeaway on what happens when the kids are not okay. Youth unemployment in Canada is at crisis levels. One estimate suggests that at the end of last year, 850,000 young people who wanted jobs in this country couldn't find them. And that was before this summer of weak hiring made the problem even worse. There's a lot of evidence that a rough start to employment can create a permanent setback for the people involved. And for young people, this is happening in Canada at a time when the future looks precarious anyway, with new technology like AI poised to make some jobs obsolete before too long. Meanwhile, the traditional fallbacks for income, like the hospitality sector, are also suffering, closing doors for even short-term financial support. Rather than wishing it were different, there's a role for governments and business to play. Governments already have jobs and training programs for young people, but they need to be stepped up big time. Why not pay unemployed students to learn new skills, from coding to construction? And why not create a new category of tax incentives for business to hire young people who are starting their professional lives? Or, for that matter, outright grants for some category of work. The idea isn't to make government the employer of last resort, but to acknowledge that we have a shared interest in ensuring the next generation is prepared for the economy ahead. What that economy looks like is hard to predict, but arming the society of tomorrow with tools and skills to meet whatever does come is definitely the right thing to do. One thing we know about humans is we need purpose. Even paying young people to do work that is normally volunteer would be a pragmatic acknowledgement that in future we may have an economy that hums along with fewer laborers. Innovating what we get up to could be an important part of a cohesive society. My takeaway, going out of our way to help the next generation succeed isn't just the right thing to do, it's the smart one. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.